Good morning, Karen. Good to speak to you. Yeah, I think, we've produced a set of strong numbers for last year, being the second year of COVID. We look forward to the current year with, I think, more optimism. I think there will be a strong recovery. Certainly, we're seeing that post-Easter into the summer. Bookings are strong, but at lower prices in Q1. We see strong bookings, but at slightly elevated prices in Q2. But I think we've learned from the exuberant optimism at Christmas, and it was damaged by Omicron at the end of November. We looked like we were going to have a very strong Easter, and it was damaged by the invasion of Ukraine. So we're still building up the forward bookings. That process is going very well. In April, for example, we hit 91% load factor, which is the first time since COVID we'd gotten over 90%. So there's no doubt there's a strong recovery underway. But I think we want to be cautious, particularly in the second half of the year. Will there be another variant of COVID? And we also need to keep a wary eye out for what happens with the unfolding Ukraine situation.
Michael, I've got to say I'm thoroughly confused about the demand story. The lines are just competing, where you're saying you're seeing pricing up single-digit percentage versus pre-COVID, but then still talking about the need to stimulate with pricing in that first quarter. Are we getting into some price sensitivity here? Is that the issue?
I don't think so. But I think the issue is we're seeing pricing slightly down pre-COVID in Q1, pricing at this point in time slightly up in Q2. So there's no doubt that there's strong peak demand. But it's fragile, as we're still building up forward bookings. We're having to price down in Q1. We're not having to price down in Q2. But if there's another negative news flow event, as we had with Omicron at Christmas or we had with Ukraine at Easter, these numbers could change very quickly. And that's why we're not able to give a full year guidance. We do expect to be modestly profitable over the next 12 months. It could be very profitable if everything goes well, but it could be damaged in the way it was with Omicron and with Ukraine if we get negative news flow.
Mike, very good morning to you from Stockholm. Look, I'm looking at the disaster that parts of the industry are having on staffing. I've seen changes that... I can't comment on who I took to get here, Mike. You know that. But the fact of the matter is, I have looked at your... Funny enough, I have looked at your pricing for a trip to Gothenburg later on, and I have to say, the prices are looking fruity, so I don't know if it's just the routes I'm looking at, but they look very firm to me. But that wasn't my question. My question is more about the costs that you're incurring. And I was looking at the changes that Delta have had to make in the United States to encourage more staff to get back in cabin crew. I've looked at the problems BA have had and the other airlines have had. Just explain to me how tough it is to get staff, to keep staff and to train staff at the right kind of cost for your airline as well, Mike.
I think there's no doubt that there are numerous staff pinch points, particularly in the UK post-Brexit, where you don't have that labour market flexibility. But, we made a commitment during COVID that we would keep everybody employed. We kept everybody current. So we were flying pilots and cabin crew. Sometimes, we'd have a once a month just to keep them all current. We haven't faced the same labour disruptions that EasyJet, Wizz and BA have suffered, for example, here in Europe. But, it's still very tight over here. We see very little labour market disruption on continental Europe. We're hiring lots of people, we're training lots of pilots, lots of cabin crew, no issues. There are security pinch points though at airports where they're hiring kind of security, baggage handlers, check-in. There are pinch points at certain airports, most notably Berlin has been particularly been a challenge. But the UK is tough. The UK labour market post-Brexit is very inflexible. It is very difficult to get people to apply for jobs, even in the case of Ryanair, where we're paying well above hospitality, well above retail. And I think it's just one of the damaging dividends of Brexit. But, we are where we are. We've seen airlines like BA, EasyJet cancel flights through the summer because they're short-staffed. We don't face that difficulty in Ryanair, but it's something we manage on a daily basis.
Yeah, and I have to say, I've done a lot of travelling so far this year, and I would say London looks just awful to get in and out of at the moment. And I don't know if that's the Airports Authority problems or BA problem or whatever it is, but real problems. But I want to talk about the other major costs as well. And Mike, I know you operate and are continuing to buy some of the most fuel-efficient planes out there as well. So kudos to Ryanair for that as well. But your aviation fuel costs must be absolutely through the roof as well. Just explain to us what your hedging policy looks like at the moment.
Funnily enough, see that we're in very good shape on the fuel hedging. You know, we continue to hedge fuel right through COVID. At the moment, we're 80% hedged out to March 2023 at under $70 a barrel. So we have a huge advantage over almost every other airline we're competing with in Europe because of the strong hedging position. I think there's no doubt, though, at the moment, if there's continued uncertainty in Ukraine and with energy supply, we're facing higher oil prices into the summer of 2023, but it's more than 12 months away. What we can confirm now is that we will go through this summer very well hedged on fuel. There will be no fuel surcharges in Ryanair. It is inevitable there's going to be fuel surcharges among the legacy airlines in Europe this summer. There won't be in Ryanair, and I think that gives us a huge competitive advantage, and it means we can continue to offer low fares into the post-COVID recovery.
Michael, can I just get a line on Boeing? I know that you're catching up with them in a couple of weeks. So what are you hoping to achieve here, and what sort of orders do you anticipate over coming years?
I think, you know, we've been very disappointed with the performance of, certainly on the commercial side, Boeing management the last 12 months. I saw some commentary recently, you know, that Boeing management has lost their way, and I find it hard to disagree with those sentiments. They've been late on the aircraft deliveries. We've heard nothing from them on the MAX 10, despite the fact, you know, we broke off the negotiations with them last September. You know, Boeing need a management reboot, certainly on the on the aircraft civilian side. They need to get some management in there that's going to resolve the aircraft delivery delays and sort out the production challenges facing both not just the MAX, but also the MAX 10 and the 787 as well.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.